Broadly speaking, the people that took this industry from 0 to 1 will not be the same ones that take it from 1 to 100.
I would love to use this conversation to basically dig into a lot more about what Frictionless Capital is all about. It is a thesis-driven fund. What does that actually mean in practice?
I think it's a term that gets thrown around a lot. Most investors will tell you they're thesis-driven, and then you ask them what they're investing in, and they tell you basically everything. So if your thesis is everything, then you don't have a thesis. But we pride ourselves in really taking a first principles approach to investing, building from the ground up without relying on analogies or pattern matching, and formulating thesis, I'd say from the engineering and physics level. And that's manifested itself in infrastructure, and now we're more application investors, given that infrastructure is scaling.
So how do you actually begin this research process, or what are the data points you try hone in on? Because there's a lot of noise in this category in particular. So How do you actually structure or scope out where you want to look?
Yeah, it's a great question. We started this process in late 21, early 22, really looking at blockchains from first principles and looking what are the basic components, what are these things actually doing from a system standpoint. And for example, one area that we focused on very, I'd say acutely, was on data propagation. So we looked at blockchains, each transaction being a certain amount of bytes. If you want to do more transactions per second, you need to propagate more bytes per second around the world, right, to all nodes. And then if 2/3 plus 1 agree on the state of the network, then the transaction is confirmed. So I think really just sounds simple, but doing an apples-to-apples comparison across all the industry, looking at some of the legacy networks like Bitcoin and Ethereum, and then some of the newer ones like Solana and Aptos, and really just looking at the numbers as they stood and letting those sort of results and findings speak for themselves. We found some blockchains were trying to push the limits of physics, like Aptos, and others were not making even a remote effort at all. They kind of were just optimizing for different things like decentralization.
So is that where we're sort of seeing this conflict of where noise is parading as signal, and so market attention can focus elsewhere, but the real needle movers are sort of still sitting in the dark to a degree?
Yeah, I would say so, definitely. I mean, there's a narrow class of blockchains, including Aptos, that have modern architectures, that are parallel processing, that have high data propagation, quick block times, which translates into low latency for transactions. That class of blockchain is doing right now 60 to 80% of all the app revenue in the industry, but the market cap of all of those projects together is like less than 4% of the industry. So something's got to give.
Why is that happening though? Why are we unable to see where the performance is really making a difference? Because we're too distracted elsewhere.
I think sometimes it's hard to tell the story of performance and infrastructure because you can't touch it and feel it. If you go to someone on the street and say, hey, do you know that Aptos has 100 millisecond block times? They don't even know what that means, right? Whereas if you give them a product and the experience is delightful and they sign a transaction and it's virtually costless and instantaneous, then you can tell the story of that performance through the context of like a product experience and a user journey. And it's sort of like the pivot has already happened where it's not about the infrastructure, it's about the applications that the infrastructure enables at scale.
So then if you are looking at this from a very research-driven perspective, and that often I'm sure puts you in a bit of a contrarian position to the rest of the market because you're stripping back and looking at what's under the hood rather than what's sort of making the most noise. How do you navigate that tension?
Yeah, it's a great question. I think a lot of folks, even going back a couple of years ago in crypto, if you ask them about monthly active users or revenue or retention or cost of acquisition, PMF, any of these like Silicon Valley terms, they'd be like, what's this guy talking about? You know, we're infrastructure guys here. We're writing white papers and we're launching tokens. Like, what is this guy even on about, you know? But I feel like the space has really progressed now where some of the fastest growing companies, not just in crypto, but in tech overall, are actually coming from the crypto space in terms of revenue generation. And now people are getting more you can call it maybe moving down the income statement. Like it's not just eyeballs per second now it's revenues. Then it's going to be EBITDA and profit and cash flow.
So it's kind of like a maturation in that way that our industry perhaps just wasn't ready for a couple of years ago.
Yeah.
So,
and it mirrors the internet as well. Internet was all about eyeballs per second and attention, right? That people talk about the attention economy, but it has to actually translate into real businesses that are not better products, or else it's just entertainment.
So then what are you keeping your eyes on at the moment?
Yeah, I'd say we're broadly focused, kind of unsurprisingly, these blockchain systems are ledgers. So they're great for payments and trading. And as they get more performant, you can actually do price discovery on the blockchain, which is very interesting because you're taking what has been historically a secondary market and now making it a primary market for launching new assets of all kinds, right? That's one area of focus. And then the other area of focus I'd broadly describe as coordination, which is blockchains are giant incentive machines. And through shared ownership with tokens and everyone unifying around a single standard, you can coordinate all these unaffiliated parties where like before this database from this bank couldn't talk to that one, or there's no way to have people rally around a cause or a project to incentivize behavior before blockchain. So perhaps one way to put it is if AI is an intelligence boom, I think crypto is a coordination boom.
Mm-hmm. So when we're talking about understanding product potential and then basically understanding like product design and how they intersect in the middle to actually create something meaningful.
Yes.
Who's doing it well and who's still falling short but kind of still getting an undue amount of attention?
I think it's a great question. A lot of crypto native folks are too focused on the metagames of like, I build a product, then I get KOLs, or I get a listing on a certain exchange, and then I kind of that the token is a product. These are all very short-term games. But what we're seeing now is a trend towards more sort of non-crypto native founders coming into the space. They're perhaps working for, say, AWS or Palantir or even like Tesla or SpaceX. And now they're looking at crypto not as crypto being the product, but crypto being an implementation detail that allows you to build a net better product. And it's sort of that, perhaps not fresh out of college. A lot of those college graduates are going into AI now. But we're seeing guys who are maybe 5 to 15 years in, they understand the value chain, they have industry-specific knowledge, and they can sort of point out the areas where crypto can be applied.
So that sort of deviates us away from the cypherpunk ethos that, crypto was really born out of. And so that ideological split has also created some level of tension because it's sort of an in-group versus out-group thing. And I think also when it comes to the short-term mechanics of a lot of these product launches, that's something that people have become habituated to, and not only habituated to, but they like them because it's something that they can immediately capitalize and optimize from. So how do we break that dynamic in a way that brings our industry forward for the longer term without alienating the very communities that sort of brought it to this position in the first place?
I think, broadly speaking, the people that took this industry from 0 to 1 will not be the same ones that take it from 1 to 100. And I think this happened with the internet as well. Like you had your original sort of like interweb guys who were, on the forums, and they were, early adopters of, say, like America Online and some of the chat-based stuff you could do with dial-up on like a 56K modem. But ultimately, the 0 to 1 moment happened. The standard was set with HTTP, and then that enabled things like email, right? And email actually got 1 billion people on the internet. So it's sort of like there's these broad waves in tech where at one point, internet companies were not considered serious technology companies. You had like, IBM and Microsoft. They were like, those were serious tech companies. And then you had these internet kids doing their thing in the corner, right? And if crypto feels a little bit like that as well, where you have like serious tech, then you have like crypto. But eventually crypto will just move into the zeitgeist of what's considered tech. And then crypto companies are just tech companies or finance companies.
So then who have you got earmarked as winners for the long game?
I think there's a couple that are taking a radically different approach. We're the first investors in Backpack Exchange. They're really building a new financial institution from the ground up. So they're taking the best properties of crypto, including, verifiability, the trust minimization aspect. They're using encryption, and they're using all these leading edge practices to reimagine what, say, a new JP Morgan would look like from the ground up. And I think that's interesting because it's very hard for these traditional incumbents to sort of disrupt themselves. Their incentive is to really perhaps stifle innovation, right? And they want to keep the show going. And if they're a multi-trillion-dollar player, then obviously they're already winning, so they don't want the game to change. But generally, I think tech and crypto within that is one of the few subsectors that has a possibility to disrupt some of these traditional players, especially on the finance side. I sort of used to work as an investment banker for 4 years, and I think finance more broadly in capital markets is one of the last industries that hasn't been disrupted by tech yet because of all the regulatory capture and bureaucracy and red tape around it. But obviously the opportunity looms very large, right? Because financial services and capital markets are some of the largest markets in the world.
Is it also because a lot of those industries or structures are just a lot less understood and therefore not necessarily the first points of consideration as a space to disrupt or as a space to innovate in?
I think it's also just the regulatory framework set out in the United States in 1933 and 34, post the sort of Wall Street crash and Great Depression in 1929, in October of 29. They enacted legislation that would protect retail consumers and not just consumers, retail investors. But obviously it's been almost 100 years and the game has changed. I'd say broadly, the implementation of these markets and how markets are made and how liquidity is provided and how people trade and move throughout their day has taken a new form, but largely it's somewhat the same. It's still kind of running on industrial era financial rails of like in the sense that if I send you a wire transfer, it still takes it 1 day to settle, whereas on Aptos it would take 100 milliseconds, right? So it's less about perhaps the new internet pitch that we got in 2021 and more about if we were to reimagine finance from the ground up, what would that system look like? And what would be possible in a world where you can settle and do execution in, a fraction of a second for almost, no transaction fee.
And I mean, we've seen a lot of momentum in the regulation space in the past year. But what's it really going to take for regulation to really match the level of innovation that's taking place? Because we've seen a lot of experimentation. Not all of it will stick, and fairly so. But how can regulation anticipate what the end result is going to be as we're building this all in real time? Because we are testing new financial systems as we fly the plane. And you can understand that it's probably very difficult for a legislator to anticipate the guardrails they're going to need to set up for a system that isn't finished. So how do they find that middle ground where they're not disruptive to the innovation that's taking place, but they still have the safety that we're sort of seeking as an industry?
Yeah, it's a great point. And honestly, I think this is a very timely conversation given that we're coming out of a very, what was previously a very hostile administration towards crypto, right? That actively sought to suppress and actually in some cases kill certain pieces of the industry. Now what you're seeing is a much more common sense approach where the innovations are real. For example, BlackRock has launched the Bitcoin ETF. It's now their fastest growing ETF in history. It's their largest by revenue, right? So the desire for consumers to actually hold crypto can't be understated, and it's not going away. Once you let the genie out of the bottle is kind of what we say, you can't put it back in. So generally, I think what this administration has brought is really a much more common sense approach where instead of regulating by enforcement, they're providing guidelines and guidance letters. And even as of late, the SEC chair has spoken about innovation exemptions as well as safe harbors, which is historically how these tech innovations have been regulated, is to provide a safe harbor and say, okay, along these guidelines, if you abide by this safe harbor, you can get an exemption and you won't get prosecuted. So people are free to operate their businesses within those guidelines. And then in the meantime, the regulators can observe the space. They can see where the abuses are happening and they can see where people need to be protected. And then they can design a tailor-made framework around what's actually happening.
Is there a risk to the politicization of crypto in this way, though? especially given, like, let's take the American political system as an example.
Yeah.
It is very much a two-party system. So it's very difficult to cater to one party without alienating the other. While the current administration is more favorable to crypto legislation, there's always the fear that it might be reversed if the next presidency seeks to undo some of the progress that's been done.
Yeah, I think it's a great point. I think it has become a partisan issue for better or for worse. But ultimately, the United States in particular, has the ability to always embrace innovation. And it's what led them to be home for the biggest internet companies and to attract really talent from all around the world, right? If you look at the founders of companies, even early internet companies and hardware manufacturers and folks like founders of like Sun Microsystems and all these like sort of like foundational companies, they weren't all American. They were from all over the world, but they decided to take their talents to the United States and then take those companies and those ideas to market in U.S. capital markets.
Yeah, because I think we often market or understand blockchain and crypto as a very global technology, but we are still very much rooting it in geographical capitals and saying, the US is the home of crypto, even though we're also touting it as this permissionless distributed system. So there's kind of an oxymoron that exists in there, but at the same time, it's creating enough competitive drive that's putting momentum within the industry.
Yeah.
So in a way, it's a double-edged sword. How does that taper out in the long term?
I think on one hand, a lot of investment and perhaps more active market players like market makers and institutions that are trading on the blockchain or investing in them, those I would say generally are concentrated more in like North America and primarily North America, to a lesser extent Europe and Asia. I think the pull has definitely shifted from Asia a bit more to the United States, just given what I was saying as well of like the institutions that take us from 1 to 100 are now more large players, right? They're asset managers, they're sovereign wealth funds, they're pension plans. They're folks that are deciding to allocate to these assets because they view this as a very fast-growing alternative asset, which now crypto is the fastest growing subsector of alternatives. So I think generally it's an allocation question for them on the investment side, but then in terms of the impact, it's global, right? Because if you can democratize access to financial products that were only available to Americans, and you can say, hey, you can use Petro Wallet on Aptos, and it's like a dollarized savings account for someone in the developing world or the global south, this is actually a killer use case for them, right? They desperately want dollars, they desperately want savings yield, and they want to be able to hedge against perhaps like turbulence and volatility of a local currency or risk of seizure or confiscating or whatever. So
I think that's what's been so interesting is that we talk about a lot of the innovation that's coming out of the States, but then when we talk about utility, we're talking about emerging markets.
Yeah.
So there is that separation there. And I guess the question becomes, when does it really start to root itself in the way that people transact locally here in America?
I mean, in America, people have very developed financial systems. So you have your pick of, 10 banks or 20 banks that are all great, or even regional banks.
But they still can't settle transactions internationally very quickly.
They cannot, right? Because we're still running on industrial era financial rails. Whether people will admit it or not, banking has not moved on to the internet, right? And this is broadly, I think the trend is like, who's going to take Wall Street and Main Street banking and put it on the internet? I think it's the blockchain. So it's one of the last industries that hasn't gotten essentially put on the internet. We've seen the transition of money from barter system in ancient times to paper trading and paper currencies, which were like a proxy to the barter system. Then we went to electronic trading, and now we're going to assets and money over internet protocol, which is the final step.
So what is there to say about what fintech has accomplished in the past decade separate from crypto?
Yeah.
Because, coming from Asia, our digital banking is fairly sophisticated. We can transact across borders relatively quickly, sometimes expensively.
Yeah.
But the infrastructure is there for people to tap into and to use. And then blockchain promises that, I guess, but accelerated and much cheaper.
Yeah.
But I think there's a little bit of a disconnect in terms of the use case and saying like that it doesn't exist there, but it does, but it's just a little different.
I think really what fintech platforms and a lot of them are multi-sided platforms. What they've accomplished by and large is to take pieces of what was perhaps part of a legacy banking service or system and begin to have those move at internet speed. But they were still siloed databases, right? If you look at Stripe's database doesn't talk to someone else's. They have their own silo. So really, I think the promise of blockchain is not just having finance and trade and settlement and execution move at internet speed. It's putting everyone on one ledger so that everyone can opt into a shared system where you have global liquidity, global access, and it's democratized, right? Whereas if you try to do things in fintech, they're still very much private ventures. It's not public financial infrastructure. Now we're talking about public blockchains that are publicly accessible and verifiable.
So if we're pulling Aptos into this conversation, why is Aptos such a key winner for Frictionless?
We really think about this in terms of our research having led us here. We've been looking at data propagation for a number of years and published pieces on this going back 3-4 years ago. We've been looking at market structure and the importance of having low latency and how that affects the way price discovery happens and how assets are issued and settled and execution happens. Generally, what we've seen is a trend towards essentially lower latency over time and a continuous streaming of blocks, which is what Avery and the team have been able to accomplish. So when we look at it, we see infrastructure that's ready for prime time. We see a very performant blockchain, and we see one where builders can build legit businesses and start earning revenue overnight, right? And it's both an interesting new tech stack, but also a new frontier for user acquisition, because if you deploy an application today, you have users and you have liquidity that's ready to use it instantly, right? You don't have to do a traditional go-to-market and put up billboards or do advertisement or acquire users other ways.
Do you think there's an element of what's been innovated on Aptos that's sort of slept on that should really be amplified further?
Yeah, I think generally the focus on verticalization now with Decibel and Shelby is very interesting to us, because in the past, blockchains would be very unopinionated on projects, right? Ethereum famously would never tweet about a project, or they would never spotlight anything because they were credibly neutral infrastructure that was sort of trust minimized. And then I believe, throughout the years, other blockchains got a little bit more opinionated, and now culminating in what I'm describing as Aptos approach, where you're actually taking tier one talent from Facebook, Libra, the DM team, and they're building verticalized applications end to end that are serving both as the liquidity and execution layer with Decibel, as well as the backend services side with Shelby. So if you think about what every startup founder needs, they need a checking account, and they need a place to trade and settle and pay people. They have that with Decibel. And they also need sort of the Amazon Web Services or Google GCP to run their business. You have both of those pieces on Aptos, and it's running on highly scalable protocol.
So there's basically the infrastructure layer.
Yeah.
And then there's the conviction of where it needs to go next to have more of its utility sort of baked into that infrastructure.
And it starts to be just a single API. If you want to build a business, come to Aptos. Use Decibel, use Shelby, and it's scalable, and you don't have to worry about running your own infrastructure or, any of those back-end considerations.
And Frictionless is also invested in some of the ecosystem projects that are on Aptos. So what's driven the research and the conviction behind those projects in particular?
Definitely. We are early investors in Panora, which is a primary aggregator, spot aggregator on Aptos. We have a thesis around sort of this, what we're calling the interactive brokerage of crypto, where to the extent that liquidity becomes fragmented across different DEXs, AMMs, order books, and so on, retail has a harder and harder time actually navigating to all those front ends and seeing where they can get the best price. So Panora does the hard work and the hard job of actually finding those routes and matching a trader who wants to, say, buy or sell said asset with the best execution. It's sort of this notion of best bid or offer that exists in traditional finance, but bringing that to the blockchain.
So a lot of what we've discussed is basically how your approach as an investor is to seek out that little green sprout amidst the rubble, or that comes through the crack of the concrete. When do you get to really see what's flourished and see whether your hypotheses have been correct?
I mean, we're very data driven. We're looking at the metrics constantly. And when you have a product or a protocol where people are paying money to use it daily, day in and day out, that's a sign that it's a net better product, right? Because if not, why would they be paying for it? So generally it's reflected in the metrics, but we can also confidently size these markets and make bets even prior to any indication that it's currently successful. We're investing obviously pre-product and pre-revenue as well. So it does involve a leap of faith, but we've done a lot of work on this stack to
educate to
be able, yeah, of course. And it's just also the ability to sort of have the confidence that, if this view of the world, which I've described, which we do think is correct, if it plays out, where is the value going to accrue? And then make concentrated bets accordingly.
So then if you're looking more broadly at the industry and you've got your thesis that gives you the competitive advantage as an investor, then you're also watching how the market might move contrary to that. What do you think is ultimately holding us back as an industry that you wish people paid more attention to? Or do you kind of get more benefit out of this sort of competitive dynamic?
Being an investor and being a VC, it's not a popularity contest. If we wanted to be popular, we would back the current thing. We'd back the thing everyone agrees is a good idea. I think that would have disastrous consequences for our portfolio. You have to really be unafraid to make a bet and really just not rely on anyone else for conviction. Build your own conviction internally. It's kind of a solo game. And do that independent study and research on the market sizing and understand the value chain and where value is going to accrue. And then don't be afraid to bet big, because ultimately the market will decide who's right and wrong. And the more time that goes by, your investments get validated in real time. And I think that's one of the best things about this game is that we don't have to, you don't have to take our word for it. You can look at some of the companies we've backed and you can see how well they're doing. And that's a better validation of our focus and our research than anything else.
And how do you keep that steel disposition when the market looks like it's running against your bet?
I mean, our research guides us. We've been contrarian in the past. We expressed a very strong thesis on high-throughput blockchains in the depths of the bear market when no one thought it was a good idea. And now 70 to 80% of app revenue is built on high-throughput chains. So really, it's having that confidence to double down on yourself and double down on your research and realize if you do have edge, the dominant strategy is not to shirk away or have second doubts, but to lean in harder and double down.
So it's essentially that the market will reveal the truth in the long run.
Yeah, and the knowledge that markets are inefficient, right? Or else we wouldn't have a job.
So it's just a bit of a waiting game in that regard.
I mean, we do a lot of reading. That's a quote by Stan Druckenmiller. He said we do a lot of reading, waiting, not so much investing. We do a lot of independent study, and then we see a lot of deals, but we don't do a lot of deals.
One of the more exciting things that's happening at this time that you're not necessarily participating in, but you do think is a point of interest?
I would say generally the prevalence now of prediction markets is quite interesting to me. I mean, at a basic level, they're essentially exchanges that offer perpetual swaps that settle to 0 or 1 with a binary outcome. What's more interesting is the fact that you have user-generated markets. So the users themselves on the platform can express a view of like, here's the market I want to trade. And that can happen without a listing team or without a human having to grant permission.
It's almost like building spontaneous markets out of anything.
Correct. And people just almost kind of wanting to play fantasy sports on life, not just on, a football game.
And then what's the thing you think is overblown that we shouldn't really be investing as much attention into?
Probably stablecoins. I think they're more of a feature than a product. I've kind of a hot take, but I think stablecoins are not as interesting in and of themselves. It's more interesting to think about what you're going to do with that stablecoin to enable a new or unique experience or product or service. And is that stablecoin supply actually, or float actually being utilized in a productive way to generate yield or fee-paying volume or something else, or to facilitate new transactions?
So it's almost like a gateway innovation rather than the end game itself.
Correct. Like as a category, people weren't investing in the internet per se. It was more, what can you do with the internet to build a better business? Right?
So it's the utility that exists at the end of its production.
Correct. So it's using stablecoins as an implementation detail to enable a better product. So I sound like a bit of a broken record, but
No, I appreciate the fresh perspective because I think a lot of people have been extremely interested and excited by what stablecoins have enabled this year.
Yeah.
But in terms of understanding, it is not as remarkable as what we've paraded it to be, I think is a novel take.
Exactly. And it has to be venture fundable as well, right? If it's something where, you can say, okay, Walmart implements a stablecoin, that's great. That enhances their business. But how do I, as a pre-seed and seed investor, get exposure to that? I can't. So it's also the matrix of like, what is a better product that's fundable at a reasonable valuation?
Right. And I guess it's also about what's a better product that's investable to you as a VC versus its broader utility to just exist within the marketplace.
Exactly. And I think we're really just the ones that are funding these ideas, the crazy ideas and the radical products that perhaps people don't think they're a good idea, but that's fine because we're the ones that are taking a 3 to 5 to 10 year view on what the world's going to look like. And if we're directionally correct about that worldview, and we've been investing as if that's going to happen, and then it happens, that's when we have the venture scale outcomes.
Right. And I think that long-term game is something that's become a lot more apparent in conversation when previously we were looking at more short-term sprints.
Exactly. And also the knowledge that you can't fund your product or service with traders. They're too impatient and they'll leave your project. You need the patient capital, right? You need the patient capital that will actually pick up the phone in the middle of the bear market and like help you figure some stuff out.
Right. So there's a distinction in that capital where it's venture funding that's very much rooted in the development of the business model. And then there's the short-term trader game, which sort of lubricates the system, but isn't necessarily the lifeblood of how project will sustain itself in the long term.
Exactly. We're investing in software built on high-throughput blockchains that generates revenue. And then we're helping build the machine. And then the traders will help power it.
Amazing. Well, Diego, thank you so much for your perspectives. It's been really refreshing to hear. So until we speak again.
Thanks so much.